Hello and welcome to this session in which we will discuss the capital structure components. Capital structure refers to the way a company finances its operation and growth by utilizing various sources of capital. What is capital? Capital is money. Simply put, how does the company finance itself? Well, they finance itself through two different methods. They can finance themselves by the combination of debt and equity. Now, what does that mean? Well, if you remember the basic accounting equation, we're going to go back to the basic accounting equation, and we state all your assets are coming from two sources: liabilities, which is debt, and equity, which is stockholders' equity, and for simplicity, stock. So how do you finance your company? You finance your company from debt and stock. This is what we mean by capital structure. For example, you could have $100 in total assets. For example, this is your total asset. $30 could be coming from debt, and $70 will be coming from equity. And this is your capital structure. Now, why do we need to know about the company capital structure? Because whether you finance yourself through debt or through equity, it makes a difference to your risk profile. What does that mean? If you finance more of a debt, if you rely more on debt require interest rate payments, and interest rate payments are fixed payment. Interest rate payments are mandatory. On the other hand, equity, if you finance yourself through stocks, you don't have to pay the shareholders unless you make money. The shareholders are taking the risk. The shareholders are the owners of the company. Therefore, in this session, we need to only discuss the nature of debt, because we're going to have many types of debt. We're going to have few types of equity. We could have many types of debt. We need to discuss those. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Starting with equity financing. So we can finance ourselves, again, we can finance ourselves through equity. So we're dealing with equity. For equity, one common way to finance ourselves, it's the most common way, is issuing common stock. What is common stock? Common stock is when the company wants to get money. So this is the company, and they want to raise money. They want to bring money. So what do? They give the investors common stock, which is what's common stock? Ownership in the company. And that's how they bring money to the company. So this is one way to finance yourself. Represent ownership, and typically gives the shareholders voting rights. The shareholders are the owners of the company. Common shareholders might also receive dividend. Notice it may, because if the company don't make a profit, they don't get any dividend. What is dividend? Dividend is a payment from the profit to what? Reward the people that invested money in the company. You may and may not. Even if you make profit, you don't have to pay the shareholders. The company decide, the board of directors. Notice it's not guaranteed. Now, also what I want to tell you is in the real world, we have Class A, Class B, Class C. We could have different type of common stock. Not common, but it could happen. Now, you have to bear in mind, since common stockholders, the people that invest in the company, they are the latest to be paid in case of liquidation. So if the company went out of business, they are the last group to get paid. And oftentimes, if they file for bankruptcy, they don't get anything. They bear the risk. The shareholder bears the risk, and they bears the reward. So if the company does very well, they get most of the profit. But if they don't do well, which is basically they're the owner. So this is one way to finance the company, through common stock. Another equity financing method, the common method, is preferred stock. Notice they're both stock, but this is a preferred, a different type of stock, not a different class. Remember I said here we have Class A, Class B, Class C. This is not what we're talking about. Preferred is totally different type of stock. They have a higher claim on the company's asset. What does that mean? So in case the company went bankrupt, I told you common stockholders, they're the last to be paid. And right in front of them, you have the preferred stockholder, right before the common shareholders. So sometimes they may get some money. This is what we're saying. So in case of liquidation, they have a priority over common stockholder. Simply put, they are taking less risk. And when it comes to earnings, they might earn in some years more than the common shareholders. They receive dividend before, and this is why they are called preferred. They are preferred because they get their money first. They got their money first. And they might have specific rights, such as the ability to convert their shares into common stock. Now you have to understand, preferred stock comes in many different flavors. I told you common stock, Class A and Class B, but common stock, we could have 50 different ones. They come in different flavors. We could have cumulative versus non-cumulative preferred. What does that mean? Cumulative means in case you did not pay me dividend in year 1, you owe me that dividend. You did not pay me in dividend in year 2, you still owe me that dividend. When you make money in year 3, you have to pay me year 1, you have to pay me year 2, and you have to pay me year 3 before you pay the common shareholders, if it's a cumulative. If the dividend is non-cumulative, if you did not pay me year 1, you did not pay me year 2, you don't owe me anything when you pay me year 3, you only pay me year 3. Preferred stock could be convertible. Preferred stock could be callable. What's the difference between the two? Convertible is when the shareholder, when the person holding the stock, convert the stock into common stock. That's a feature. So you buy a preferred stock, but you have the right to convert it, which is good. It's an option. Callable, on the other hand, it's callable by the company. What is callable? Callable means the company, at any point in time, they can call back the stock. It means they can tell you, sell us back the stock at a certain price. Again, preferred stock are a form of a contract. So you could have any type of stipulation, Remember, they have priority in case of liquidation, priority over common shareholders, not over everyone, over common shareholders. So those are the two main sources of equity. Now in this session, we'll talk about the cost of common stock, the cost of preferred stock, because they have different costs. Let's move to debt. Remember, the accounting equation, assets equal to liabilities plus equity. We talked about equity. We said we have common stock and preferred stock, and this is how we raise money through equity. Now let's talk about debt, which is the liabilities component. Debt comes in different format. I'm going to start with the most common one, which is a loan, notes payable. Notes payable is a liability on the company's balance sheet, represent the amount the company borrowed, owes to creditors or lenders through the issuance of promissory notes. So basically you borrowed money. That's one way to finance yourself. Those are written agreement that outline the terms. So you have the loan, you have all the details, including how much you're going to be paying back, what interest rate, the repayment schedule, details, conditions, so on and so forth. Notes are certain notes are short term, others are long term. How do we know whether it's a short term or a long term? If it's less than a year, it's short term. If it's longer than a year, it's long term. Now again, this is one type of debt. Another type of debt that's common is bonds. What are bonds? Well, it's another form of financing. What's the difference between a note and a bond? Well, okay, let's talk about the notes. Let's call them loans because it's easy for you to understand. You go to the bank and you get a loan. Usually think of it this way. You don't have to go to the bank. You can go to another financial institution, but let's say banks. When it comes to bonds, the way bonds work, you can go to anyone. And anyone means you can go to the bank, you can go to individuals, you can go to financial institution. You can borrow money from anyone by selling them a piece of paper, like a written promise, and borrow the money from them. This is what a bond is. We're going to have a separate, more recordings about bonds, assuming you don't know what bonds is. A bond is a company would issue bond to raise capital. It's a form of financing. Bonds are debt securities that typically have a fixed interest rate. Typically, it could be floating, but typically fixed, and a maturity date. The bondholders, whoever gives you the money, they expect to receive regular interest payment, and you expect to give them back their money when the bond mature. Again, we have many types of bond. One form is convertible. It allows the bondholder to convert the bond into, for every bond you get 10 stocks or 15 stocks or whatever, which is a good feature. Other potential for capital appreciation if the issuer stock prices, so you will do better. The stock price rises, you take your bond, you convert them into stocks, and you make a profit. Typically offer lower rates, offer lower coupon rates. compared to non-convertible. So when a company sells a convertible bond, they don't have to pay high interest because they are compensating you through that convertible feature. A case in point is Tesla. The company Tesla, what they did is they issued many convertible bonds, and whoever bought those bonds, they did very well because Tesla stock skyrocketed. And what did they do? They converted the bonds into stocks. Another type of bonds is a floating rate bond. Remember, we said typically it's fixed, but you could have also the floating. Floating means the interest payment that you have to pay to the bondholder, it varies. It could go up, it could go down. It's tied to some benchmark, for example, LIBOR. That's why. It's provide some protection against rising rate for the lender, as coupon payment, the payment that you have to pay, will increases. Another form of debt financing, again, bonds, different type of bonds. We could have what's called a secured or a mortgage bond. What does that mean? It means it's a type of a bond that's backed. Backed means it's guaranteed by specific asset or collateral that the issuer pledged to bondholder. Or what does that mean? It means when you give money to the company, and if they gave you a secured bond and they cannot pay you, you can take the asset that they pledged. If they pledged their building, their inventory, whatever they pledge. Okay? Now, these assets provide a layer of security to bondholder in case of the issuer. So you have more protection. You would be more willing to give them the money. Why? Because you are secured. Secured bonds are also known as asset-backed bonds or collateralized bond. It means they are backed by some asset. We're going to go from secured bond to what we called debenture or unsecured. And what's the word unsecured means? It means you give them the money and your money is unsecured by anything. Type of debt security that's not unsecured by any collateral. Unlike secure bond, these bonds are trusted. They are backed by the credit worthiness of the company that's given them, that's issuing them. Now, the debenture bond usually are a little bit more expensive. It means it costs the company more money because they have to compensate for the security. But usually the company that issued the debenture bond are very much trustworthy. They have a good credit. They have what's called credit worthiness. Again, do two types of different bonds. More types of bonds, high junk bonds, just issued by companies that don't have a good credit, low credit. Remember, if you have a good credit, if you have a perfect credit, you could issue the debenture bond. And hopefully you will be able to also issue them at a low interest rate. Well, if you don't have a good credit and you want money, you're going to have to issue junk bonds. Make them riskier. And as a result, the company will have to pay more in interest rate. They offer higher yields, higher interest rate to compensate for the increased risk. Investors may include income-seeking investors willing to take on more risk for return. So this is who buy them, people who want the income with the risk. Then there's all sorts of different bonds. Just to give you an example, there's green bonds issued to finance environmentally friendly project. Funds raised must be used for a specific eco-friendly, attract responsible investors interested in sustainability. The reason I gave you this example, green bonds, just to tell you there are many different types of bonds, income bonds, there's all sorts. Okay, so just so you know that those are not the only limited amount of bonds. Let's talk more about debt financing. Debt financing could also come through trade credit or accounts payable. It's a form of financing. Total credit, trade credit, not total credit. Trade credit represent the credit extended by a supplier to a company. So when your supplier gives you 30 days or 60 days to pay, they're financing your company, they're financing your operation, they're financing your working capital. Accounts payable is an example of that. Short-term obligation to finance the company from the suppliers, the money owed to the supplier. While not a traditional form of capital, so this is not how you really finance yourself. Usually, when we say assets equal to liabilities plus equity, what we mean by liability, we mean two things. Loan, let's use the proper terms, notes and bonds, what we covered already. So yes, you could have other liabilities, but usually those are the big ones, the loans, notes payable, and bonds. But accounts payable could also be another form to finance what we call working capital. And what's working capital? Current assets minus current liability. There are other forms of debt financing, which is commercial paper. Commercial paper is a short-term debt instrument commonly used by corporation. Again, those corporations, they have to have high quality credit rating, just like, you remember, companies that can issue debentures to raise funds for short-term financing need. Typically, when you borrow money through commercial paper, the company will give the commercial paper and they'll have to pay back the money within few days up to 270 days. To be a commercial paper, it has to be 270 days. Those are issued by large corporation. Usually they come in denomination of 100,000. So when they want to borrow, one commercial paper equal to 100,000. So what happened is this. Let's assume the company needs $1 million to meet their payroll. They go to the market and they issue commercial paper for $970,000. So someone will give them $970,000 today, and they will tell them in 20 days we'll give you back $1 million. Okay, so notice they borrowed $970. Whoever lent them the money in 20 days will get $1 million. 20 days less than 270. That's what a commercial. It's a valuable tool, and that's what a commercial paper is. It's a valuable tool for corporation and financial institution to do what? To efficiently manage their short-term cash flow requirement. When they need money real quick, again, who can do this? High quality companies, because they are trustworthy. When you want to borrow money, you want to reflect trust in the market so people are willing to lend you money. What should you do now? Go to Farhat lectures, maybe work MCQs, look at additional lectures, resources that's going to help you do what? Do better, whether you are a CPA exam candidate or an accounting student. Now again, those are not the only form of debt financing. We have leases, we have other stuff, but we covered the major ones. Good luck, study hard, and stay safe.